They'll tell you Tether is risky. They'll tell you STD is one bad day away from the blowing up. They'll talk about Bitcoin on the balance sheet. They'll talk about gold. They'll talk about insolvency. But here's the truth. No one in traditional finance wants to admit Tether is safer than the banks criticizing it. Let me explain. Section 1. Banks are fragile by design. The modern banking system is built on fractional reserves. That means your bank doesn't actually hold your deposits. Banks keep somewhere between 0 and 10% of customer money in cash, and they loan out the other 90%. Mortgages, commercial loans, auto loans, long-term bonds, duration risk, credit risk, hidden losses, all of it stacked on 10 to 30 times leverage. This system is fragile. This system requires bailouts. This system depends on the Federal Reserve and the FDIC to survive. And when things go wrong, like Silicon Valley Bank, Signature, or First Republic, the entire banking model shows how vulnerable it really is. That's the system telling you that Tether is risky. Section 2. What Tether actually is. Now let's talk about what Tether actually does. Because it is not a bank. It doesn't loan out deposits. It doesn't run a loan book. It doesn't use leverage. Tether holds 100% plus reserves, mostly in U.S. Treasury bills, cash overnight repos, money market funds, the safest, most liquid assets on Earth, and the Bitcoin and gold everyone screams about, those are not reserves. They are part of Tether's equity cushion, a buffer on top of the fully backed reserves. If Bitcoin falls, Tether's shareholders earn less, but USDT remains fully backed. This is closer to a money market fund than a bank. It's built to be conservative, built to be liquid, built to be stable. Section 3. Why bank lobbyists blocked stablecoin yield. Now here's where things get interesting. A few years ago, stablecoins explored the idea of sharing yield with holders. Imagine earning T-bill returns just for holding USDT or USDC. Bank lobbyists immediately shut it down. They pressured regulators to block stablecoin issuers from paying interest. Why? Because if people realized they could hold a fully reserved digital dollar that earns more than a savings account, millions would stop using banks. So regulators blocked yield sharing. But they left one loophole. Exchanges can offer rewards for staking stablecoins. Banks couldn't kill it entirely. But they sure tried. Because stablecoins don't just compete with banks. They outperform them. Section 4. Why Tether matters globally. Outside the United States, stablecoins aren't a toy. They're a lifeline. In countries suffering inflation, corruption, capital controls, or broken banking systems, USDT is freedom. People use Tether to protect their savings, to escape hyperinflation, to store value in dollars, to transact globally, with or without a bank account. Tether is helping millions survive what their governments and banks have failed to fix. It is financial inclusion at global scale. Section 5. Chamath's breakdown. Chamath Palihapitiya recently met with Paolo from Tether and explained it perfectly. Tether built an insanely profitable business by holding short-term U.S. Treasuries. It's conservative. It's over-collateralized. It's generating billions in free cash flow. And it's solving problems the banking system won't solve. That's not risk. That's innovation. So the next time someone tells you Tether is dangerous, remember who's talking. A banking system built on leverage, fear, and government backstops is calling a fully reserved digital dollar risky. But the truth is simple. Banks run risk. Tether runs cash. And the world is starting to notice. By ICT.